Before we dive in, it is critical to understand that this presentation and the information provided in this video are for educational and informational purposes only and should not be considered financial or investment advice. I am not a financial advisor. The cryptocurrency market is highly volatile and carries significant risk. You should always conduct your own thorough research and consult with a qualified professional before making any investment decisions. Your financial situation is unique, and any decisions you make are your sole responsibility. You see the headlines every single day. Bitcoin surges to a new all-time high. Ethereum's new upgrade could change everything. A brand new meme coin just made a 23-year-old a millionaire overnight. And then the next day, the market crashes. A major exchange is under investigation. The government is planning a crackdown. It's a constant fire hose of information, of hype, of fear, and of conflicting signals. It's designed to make you feel overwhelmed. It's designed to make you feel like you're always one step behind, perpetually on the verge of either missing out on a life-changing opportunity or making a catastrophic mistake. You're left wondering, what does any of this actually mean for me? For my savings? For my future here in the United States? But what if I told you that 99% of the crypto news you see is just noise? What if the real story, the one that truly dictates the winners and losers, is happening behind the scenes, in places most people never even think to look? What if you could learn to see past the daily price charts and the sensationalist headlines to understand the powerful undercurrents that are actually moving the entire market? That is exactly what we are going to do today. We are going to cut through that noise. We're not just going to talk about today's price movements. We are going to give you a powerful framework, a new lens to see the entire crypto landscape in the United States. We're going to decode the three silent forces that are really shaping the future of digital money in America. By the end of this presentation, you won't just consume the news. You will understand it. You'll know what matters, what to ignore, and how to spot the major shifts before they become front-page news. The first and arguably most important silent force is the war being waged in Washington, D.C. Now I know what you're thinking. Regulation. Sounds boring. Sounds complicated. It's the part of the news that makes your eyes glaze over. Most people hear the word regulation, and they either tune out or they panic, imagining the government is just going to ban everything. For years, that's been the common wisdom. But in today's America, that is a dangerously outdated view. Regulation is no longer a sideshow. It is the main event. It is a high-stakes, multi-billion-dollar chess match being played between the titans of traditional finance, the disruptors of new technology, and the most powerful government on Earth. And the outcome of this match will fundamentally determine the future of this asset class for decades to come. It will determine who gets rich, which projects survive, and who gets left holding the bag. To understand this war, you have to understand the two opposing armies. On one side, you have the Securities and Exchange Commission, the SEC, currently led by its chairman Gary Gensler. Think of the SEC as the old guard sheriff of Wall Street. They've spent nearly a century enforcing the rules for stocks and bonds, rules written in the 1930s, long before the internet even existed. From their perspective, the crypto world is the Wild West. They see it as lawless, filled with scams, and dangerously volatile for the average American investor. Their stated mission is investor protection, and they believe the only way to achieve that is by forcing crypto to play by the exact same rules as the stock market. On the other side, you have the crypto industry itself. The innovators, the builders, the exchanges like Coinbase, and the creators of projects like Ripple and Ethereum. They see themselves as pioneers, building a new, more efficient, more transparent, and more accessible financial system on the internet. They argue that this new technology is fundamentally different from stocks and bonds, and that forcing it into an ancient regulatory framework is like trying to regulate the internet using laws written for the telegraph. It doesn't just stifle innovation, it threatens to send it all overseas, to countries that are creating clearer, more modern rules. The central battle in this war comes down to one, seemingly simple question. What is a cryptocurrency? Is it a security like a share of Apple stock? Is it a commodity like gold or oil? Or is it something entirely new? This isn't just a philosophical debate for law professors. The answer to that one question changes everything. If a cryptocurrency is deemed a security by the SEC, then it falls under their direct and very strict jurisdiction. Any exchange that lists it would need to be registered like the New York Stock Exchange. The project's founders would be subject to massive disclosure and reporting requirements. Selling it to the public would be like conducting an IPO. The vast majority of crypto projects in existence today do not and cannot meet these requirements. So, when the SEC labels a token a security, it is effectively a death sentence for its accessibility in the United States. This is why you see these massive drawn-out court battles like the SEC versus Ripple. Ripple argued its token XRP was not a security. The SEC claimed it was. For years, the case created a cloud of uncertainty over the entire industry. When a judge delivered a partial victory to Ripple, ruling that the token itself wasn't necessarily a security, it sent a shockwave of optimism through the market. It was a sign that the SEC's aggressive stance could be challenged and defeated. So why should you sitting at home care about these courtroom dramas and legal definitions? Because every lawsuit filed, every speech given by a regulator in Washington, and every bill debated in Congress is a signal. It's a tremor that precedes the earthquake in the market. When the SEC sues a major exchange, the tokens they label as securities can plummet in value overnight as fear and uncertainty spread. On the other hand, when a piece of pro-crypto legislation, like the recent FIT21 bill, passes a vote in the House of Representatives, it signals a potential path towards clarity. It tells the big money, the hedge funds, the pension funds, the Wall Street banks, that the United States might finally be creating a safe and legal way for them to enter the market. And when that institutional money feels safe, it doesn't just trickle in. It floods in, potentially sending prices to levels we've never seen before. So here is your new framework for the news. Stop just watching the price of Bitcoin. That's a lagging indicator. It's the final score of a game that was played weeks or months ago. Instead, start watching the leading indicators. Pay attention to the court dockets of major SEC cases. Follow the progress of crypto-related bills in Congress. Listen to what candidates are saying about digital assets on the campaign trail. These are the events that are setting the stage for the market's next major move. The legal battles of today are the price headlines of tomorrow. Understanding this public fight for the soul of crypto in America is the first step to seeing the market with true clarity. But this battle in Washington is just one piece of the puzzle. It's the visible public fight. There's another, even more powerful force at play, one that's operating not in the halls of government, but in the glass tower boardrooms of the biggest companies on Earth. It's the silent invasion of Wall Street into the crypto space, and it's changing the rules of the game forever. For years, the story was simple. Crypto was the outsider, the rebel yell against the financial establishment. It was the digital Wild West, populated by cypherpunks, coders, and true believers who saw a new future. Wall Street? They laughed. They called it a scam, a Ponzi scheme. Rat poison squared. The CEO of the biggest bank in the world, JP Morgan Chase, famously called Bitcoin a fraud and said he'd fire any trader caught dealing in it. The old guard, the men in perfectly tailored suits who controlled the flow of global capital, wanted nothing to do with this messy, decentralized revolution. They stood on the sidelines, arms crossed, waiting for it to implode. But then something changed. The laughter stopped. The criticism got quieter. And behind the closed doors of those glass towers, a different conversation started. It wasn't a conversation about ideology or revolution. It was a conversation about money, trillions of dollars of it. The titans of finance didn't suddenly fall in love with the idea of decentralized currency. They fell in love with the fees they could charge, the products they could create, and the immense pool of capital they could command. They saw a multi-trillion-dollar asset class being born, and they realized the single most terrifying thing for an institution built on control: they were being left out. So the silent invasion began. It wasn't a frontal assault. It was subtle. A Trojan horse. And that Trojan horse has a name you've been hearing everywhere: the Spot Bitcoin ETF. Now, ETF stands for Exchange Traded Fund. I know your eyes might glaze over. It sounds boring, like something out of an accounting textbook. But I need you to understand this because it is the single most important development in crypto in the United States today. It is the key that unlocked the vault. Think of it like this. For a decade, if you wanted to own Bitcoin, you had to go to the Wild West. You had to sign up for a crypto exchange, figure out digital wallets, private keys, seed phrases. It was complicated. It was risky. It scared off your parents, your financial advisor, and pretty much every major pension fund and retirement account in the country. They couldn't or wouldn't touch it. An ETF changes all of that. An ETF is basically a stock that tracks the price of something else. You can buy a gold ETF and its price goes up and down with the price of gold, but you don't have to actually buy a heavy physical gold bar and store it in a safe. You just buy a ticker symbol in your regular brokerage account, your 401k, your IRA, just like you'd buy a share of Apple or Tesla. The spot Bitcoin ETF does the exact same thing for Bitcoin. It's a wrapper. A neat, tidy Wall Street-approved package that lets massive conservative pools of money buy exposure to Bitcoin without ever having to touch the underlying crypto themselves. They don't need a wallet. They don't need to worry about security. They just call their broker and say, "Buy me 1,000 shares of the BlackRock Bitcoin ETF." And who is leading this charge? Not some scrappy crypto startup. It's the biggest, most powerful asset manager on the planet, BlackRock. We're talking about a company that manages over $9 trillion in assets. That's not a typo. 9 trillion. That is more than the entire GDP of Japan and Germany combined. When a behemoth like BlackRock decides it wants in, the game doesn't just change. The entire stadium gets rebuilt around them. And they weren't alone. Fidelity, a company that manages the retirement accounts for tens of millions of Americans, jumped in. Franklin Templeton, Invesco, ARK Invest. A stampede of the most respected names in finance, all rushing to launch their own Bitcoin ETFs. The very same institutions that once dismissed crypto as a joke were now fighting tooth and nail for a piece of the pie. The floodgates opened on January 11, 2024. That was the day the SEC, after years of denials, finally approved these products. In the first month alone, these new ETFs sucked in billions of dollars of new investment. Billions. This wasn't retail money from kids on their phones. This was institutional-grade capital, the kind of slow money that moves markets in a fundamental way. So this is the good news, right? This is the moment crypto enthusiasts have been dreaming of. Mainstream adoption. Legitimacy. A fire hose of new money that could, in theory, send the price of Bitcoin to the moon. Your financial advisor can finally put a piece of your retirement into crypto. The number goes up. Everyone who held on through the brutal bear markets is vindicated. It's a victory. Or is it? This is where we have to look at the other side of the coin. Because what Wall Street gives with one hand, it often takes with the other. This invasion brings legitimacy, yes. But it also brings a danger that strikes at the very heart of what Bitcoin was created to be. That danger is centralization. Remember, the whole point of Bitcoin was to create a financial system without middlemen. No banks, no corporations, no governments controlling your money. Be your own bank was the mantra. You hold your keys, you control your coins. It's a system built on personal responsibility and distributed trust. Now look at what the ETF does. When BlackRock buys Bitcoin for its ETF, who holds the keys? They do. When Fidelity buys Bitcoin, who controls it? They do. Millions of people are now getting exposure to Bitcoin, but they don't actually own any Bitcoin. They own a share in a fund. A piece of paper, a digital IOU, that is managed and controlled by a handful of the largest financial corporations in the world. We are, in effect, recreating the old system on top of the new one. We're taking the most decentralized monetary asset in human history and putting it into the custody of the most centralized entities on Earth. This creates a massive point of control and a massive point of failure. These few companies will become some of the largest single holders of Bitcoin on the planet. They will have immense influence over the network, over its future development, and over its price. Think about the power this gives them. They can lend out the Bitcoin they hold. They can create complex financial derivatives on top of it. They effectively get to play by the old Wall Street rules but with this new powerful asset. And for the average person buying that ETF, they get the price exposure but they lose the power. They lose the sovereignty. They can't use their Bitcoin to transact on-chain. They can't move it to their own private wallet. They are completely dependent on the institution to honor that IOU. What we're witnessing is a battle for the soul of crypto. On one side, you have the original ethos. Decentralization, self-custody, a peer-to-peer network for the people. On the other, you have the Wall Street model. Convenience, regulation, and centralized control, all wrapped up in a tidy fee-generating package. This isn't just a financial story. It's an ideological one. The ETF is the bridge that connects the old world of traditional finance with the new world of digital assets. And right now, there is a one-way stampede of institutional money marching across that bridge, planting their flag, and rewriting the rules of this new territory to look a lot like the old one. The question you have to ask yourself is, what happens next? They didn't just build a bridge to Bitcoin. They built a superhighway. And what's starting to come down that highway now is bigger, faster, and far more complex than just Bitcoin. The invasion isn't over. It's just getting started. That superhighway isn't just a metaphor. It's the new reality. And the next convoy rumbling down that road isn't carrying more digital gold. It's carrying digital oil. It's carrying Ethereum. And if you thought Bitcoin was disruptive, you haven't seen anything yet. See, for the last decade, the simplest way to explain crypto to your confused uncle at Thanksgiving was to say, it's like digital gold. It's a store of value. You buy it, you hold it, and you hope it goes up. Simple. Bitcoin perfected that idea. It's the impenetrable digital fortress for your wealth. But Ethereum is something else entirely. It's not a fortress, it's a factory. It's not just a thing you own, it's a thing you use. Imagine if gold wasn't just a shiny rock. Imagine if you could build things out of it. Not jewelry, but self-executing contracts, decentralized applications, entire new financial systems. That's Ethereum. At its core are smart contracts. And that's a term you need to burn into your brain. A smart contract is just a computer program that runs on the Ethereum network. It's a vending machine for everything. Think about a regular contract like buying a house. It involves lawyers, banks, escrow agents, endless paperwork, and weeks of waiting. Slow, it's expensive, and it relies on a dozen people you have to trust. A smart contract replaces all of that. It's a piece of code that says, if the buyer sends the money, then the ownership title is automatically transferred to the buyer. No middleman. No, I'll get to it on Tuesday. No extra fees. The code is the law, and it executes perfectly every single time. Now imagine that concept applied to everything. Insurance policies that pay out automatically the second a flight is canceled. Voting systems that are completely transparent and impossible to tamper with. Social media platforms where you, the user, own your data, not some corporation in Silicon Valley. This isn't a digital coin. It's a world-building machine. It's the foundation for what people call Web3, the next evolution of the internet. And Wall Street, after years of dismissing it, finally gets it. They don't just see Ethereum as another asset to put in an ETF. They see it as owning a piece of the railroad tracks for the next digital frontier. That's why the recent, shocking 11th-hour approval of the spot Ethereum ETFs was such a monumental event. It was a bigger earthquake than the Bitcoin ETF approval because it wasn't just about the money. It was about the politics. For months, everyone, and I mean everyone, believed the Ethereum ETFs were dead on arrival. The head of the SEC, Gary Gensler, seemed to be on a personal crusade against everything that wasn't Bitcoin. His agency had been sending out subpoenas, launching investigations, and signaling in every way possible that they viewed Ethereum as an unregistered security, a dangerous, unregulated asset that needed to be contained. The odds of approval, according to top Bloomberg analysts just weeks before the deadline, were a dismal 25%. And then, in the span of about 72 hours, the entire world flipped upside down. The SEC suddenly went silent. The hostile rhetoric stopped. They started engaging with the exchanges. And then boom. Approved. What happened? Did Gary Gensler have a sudden change of heart? Did he wake up one morning and decide he loved programmable money? Not a chance. The answer isn't on Wall Street. The answer is in Washington, D.C. Because while everyone was watching the financial markets, a stealth political revolution was taking place. Crypto, for the first time in its history, became a potent and bipartisan political force. It started with a piece of legislation you've probably never heard of, but it's one of the most important bills of the decade. It's called the Financial Innovation and Technology for the 21st Century Act, or FIT21. In simple terms, this bill is a tectonic power struggle over who gets to regulate cryptocurrency in America. For years, Gary Gensler's SEC has been trying to claim jurisdiction, arguing that almost all cryptos are securities like stocks. This would effectively allow them to strangle the industry in its crib with regulations designed in the 1930s. FIT21 proposes a different path. It creates a clear framework, splitting responsibility between the SEC and another agency, the Commodity Futures Trading Commission, or CFTC. Crucially, it would give the CFTC, a regulator generally seen as more favorable to innovation, the primary oversight of most cryptocurrencies as commodities. It was a direct challenge to the SEC's power. And then the unthinkable happened. This pro-crypto bill passed the House of Representatives. That alone is surprising. But it passed with a massive bipartisan vote. 71 Democrats crossed the aisle to vote with Republicans in favor of it. Let that sink in. In the most polarized, divided political climate of our lifetime, a significant chunk of the Democratic Party openly defied their own president and the head of his SEC to support a pro-crypto bill. The White House was stunned. They had issued a statement saying they opposed the bill. They expected the party to fall in line. They didn't. Why? Because members of Congress were getting an earful from their constituents. They were hearing from the 52 million Americans who now own crypto. They were seeing polling that showed crypto ownership crosses party lines. It's not a red or blue issue. It's a generational one, a technology one, and for many it's a freedom one. Suddenly, the political calculus changed. The anti-crypto stance, which seemed like a safe consumer protection position, was suddenly looking like a political liability, especially in an election year. The Biden administration saw a potential voter rebellion brewing. Led by a passionate, single-issue voting bloc they had completely underestimated. And that brings us back to the Ethereum ETFs. The leading theory in both Washington and on Wall Street is that the White House made a phone call. They saw the vote count on FIT21, they saw the polling, and they realized they were on the wrong side of a powerful new political movement. A directive was likely sent down to the SEC, stand down. Don't pick this fight right now. Don't give the opposition another weapon to use in the election. The Ethereum ETF approval wasn't a financial decision. It was a political one. It was a strategic retreat. This is a monumental shift. It means the war on crypto in the United States, the one that has been raging for the last 2 years, is potentially over. The government hasn't just surrendered. It seems to be actively paving the way for the industry. They've realized you can't ban a technological revolution, especially one that millions of your own citizens are participating in. The only choice is to create rules for it to keep the innovation, the jobs, and the tax revenue here in America, instead of watching it all flee overseas to places like Dubai, Singapore, or Hong Kong. The superhighway from Wall Street is now merging with the newly paved political highway from Washington, D.C. The two most powerful forces in the country, finance and politics, are for the first time pointing in the same direction on crypto. They are opening the floodgates. Bitcoin was the test. Ethereum was the proof that the system could be forced to change. But Bitcoin and Ethereum are just the first two cars on this highway. What's coming next is a traffic jam of thousands of other digital assets, representing everything from artificial intelligence and real-world assets to gaming and social networks. An entire digital universe is waiting to get listed, to get packaged into an ETF, and to get beamed directly into the retirement accounts of every single American. The question is no longer if this is coming to the mainstream. The question is, how do you prepare for what's barreling down on us? To understand what's coming, you need to understand the sheer mind-bending scale of the money we're talking about. Forget everything you think you know about big numbers. Forget the millionaire crypto influencers on Instagram. Forget the stories of people turning $1,000 into $100,000. That's a rounding error in the world we're about to enter. The entire cryptocurrency market at its absolute peak, everything from Bitcoin to the most obscure dog-themed coin, was worth about $3 trillion. That sounds like a lot. It is a lot. But to the institutions we just talked about, the BlackRocks, the Fidelities, the Vanguards, $3 trillion is a Tuesday. Let me put this in perspective for you. The total value of the US stock market is around $50 trillion. The global bond market? Over $130 trillion. The global real estate market is estimated to be worth over $300 trillion. And the total amount of money managed by asset management firms globally, the exact firms now launching crypto ETFs, is over $100 trillion. This isn't just a bigger league. It's a different sport, played on a different planet, with a different set of physical laws. The entire crypto market today could be a single line item on BlackRock's balance sheet, a small alternative investments bet. For years, Wall Street has been watching crypto from a distance, like a pride of lions watching a lone, energetic wildebeest. They were curious, but they weren't hungry enough to make a move. The regulatory jungle was too thick, the asset was too wild, too unpredictable. They had their own perfectly good hunting grounds in stocks and bonds. But now the landscape has changed. The regulators, through a combination of court battles and begrudging approvals, have essentially mowed a path through that jungle. They've built a road. And the Bitcoin ETF is a 10-lane superhighway built on top of that road. What this means is that the dry powder, as they call it on Wall Street, is about to get lit. Dry powder is the term for the mountains of cash that investment managers have on the sidelines, waiting for the right opportunity to deploy. We're talking about pension funds that manage the retirement money for millions of teachers, firefighters, and police officers. We're talking about university endowments like Harvard's and Yale's, with tens of billions of dollars designed to last for centuries. We're talking about sovereign wealth funds, entire countries that have pooled their national wealth to invest for future generations. Until now, it was almost impossible for these entities to buy Bitcoin. Imagine a pension fund manager in Ohio trying to explain to his board of trustees that he's opening an account on a crypto exchange and moving $1 billion of retired firefighters' money into a digital wallet secured by a 24-word phrase he wrote down on a piece of paper. He would be laughed out of the room and fired on the spot. It was a career risk nobody was willing to take. There was no insurance, no custody, no established framework. But an ETF? A BlackRock iShares Bitcoin ETF, with the ticker symbol IBIT? That's a language they understand. That's a product they already buy every single day. It fits neatly into their existing models, their risk assessments, and their portfolios. The career risk is no longer in buying Bitcoin. Very soon the career risk will be in not having an allocation to it. When your competitor's pension fund returns are 5% higher than yours because they had a 1% allocation to Bitcoin and you didn't, you're the one who has to answer the tough questions. This is the herd. And it is thundering in our direction. What we've seen so far with the ETF inflows is not the herd itself. It's the scout party. It's the first few brave explorers cresting the hill to see if the coast is clear. The real money, the slow, gigantic, methodical money, hasn't even started moving yet. These massive funds don't just wake up one morning and decide to buy $1 billion of something. They have investment committees. They have quarterly reviews. They need to do months of due diligence. They need to see the ETF trade for a while to see that it's liquid, that it works as advertised. So, the first wave of money we're seeing now is mostly from hedge funds and sophisticated retail investors. The second wave, which is now beginning, will be the independent financial advisors, the people who manage money for doctors, lawyers, and small business owners across America. They're starting to get comfortable recommending a 1 to 3% allocation to their clients. The third wave, that's the monster. That's the institutional wave. That's when the pension funds and the endowments finally get the green light from their boards. When that wave hits, it won't just make a splash. It will be a tsunami that reshapes the entire financial coastline. A 1% allocation from that $100 trillion pool of managed assets is $1 trillion. A 5% allocation is $5 trillion. Remember, the entire crypto market cap at its all-time high was $3 trillion. We are talking about a potential inflow of capital that could double, triple, or even quintuple the size of the entire asset class. This isn't about the price of Bitcoin going up or down tomorrow. This is about a fundamental repricing of the entire ecosystem over the next decade. And it's not just Bitcoin. Bitcoin is the gateway drug. It's the asset that Wall Street understands first. They call it digital gold. A simple, powerful narrative. It's a store of value, a hedge against inflation and currency debasement. It's the pristine AAA-rated collateral of the digital world. Once they get comfortable with Bitcoin, their gaze will inevitably turn to the next asset on the list, Ethereum. They'll start asking questions. What is this thing that powers decentralized finance, NFTs, and smart contracts? They'll see it not as digital gold, but as digital oil, the productive commodity that fuels a new kind of internet, the internet of value. And once they get their heads around that, they'll look at the entire ecosystem of applications being built on top of it. The flood of capital will not stop at the gates of Bitcoin. It will flow through them, seeking the next frontier of growth. What we are witnessing is the financialization of a technology. It's what happened to the internet in the late 90s. Before that, the internet was a playground for nerds, academics, and hobbyists. Then Wall Street figured out how to package it, fund it, and sell it to the public. The result was the dot-com boom, which, despite the bubble and the crash, ultimately laid the financial and infrastructural foundation for the world we live in today, for companies like Google, Amazon, and Facebook to be built. We are in the earliest stages of that exact same process for crypto. The rules of the game are being rewritten right before our eyes. The scrappy, retail-driven, Wild West era of crypto is ending. A new era of institutional dominance is beginning. This doesn't mean the opportunity is over. In fact, for those who understand what's happening, the real opportunity is just beginning. The pioneers who survived the wilderness have proven the land is fertile. Now, the financiers and the builders are showing up to construct the cities. Question is, where do you fit in? You can't fight this wave. You can't stop it. Attempting to do so would be like standing in front of a freight train. The only choice you have is to decide if you're going to be standing on the tracks, or if you're going to find a way to get on board. But getting on board isn't as simple as just buying a ticket. Wall Street has its playbook. They have teams of PhDs, quants, and analysts who have been preparing for this moment for years. Their strategy is built for trillion-dollar portfolios. You can't use their playbook. You need your own. So what does that playbook look like for the average person? How do you position yourself to benefit from this tectonic shift, instead of getting crushed by it? It starts with a question most people never bother to ask themselves. Not what should I buy, but why am I buying? This isn't just semantics. It is the single most important question you will ever answer in your investment journey. Your why is your thesis. It's your personal North Star. Without it, you're just a ship without a rudder, tossed around by the violent waves of market sentiment, chasing every shiny new coin promoted by a celebrity, and ultimately crashing against the rocks of financial ruin. Think of it like this. If you were going to build a house, you wouldn't just show up at a construction site and start throwing bricks and mortar around randomly. You'd start with a blueprint, a detailed plan that dictates every single decision you make from the foundation to the roof. Your investment thesis is that blueprint. It's the core belief that underpins your entire strategy. So, what does a thesis look like? It can be simple. Maybe your thesis is that Bitcoin is digital gold, a finite, decentralized store of value that will act as a hedge against inflation and currency debasement. If that's your blueprint, then your decisions become clear. You buy Bitcoin. You don't get distracted by a new dog-themed meme coin promising a 10,000% return, because that doesn't fit your blueprint. When the market crashes and fear is everywhere, you don't panic sell. In fact, you might even buy more because your core belief, your thesis, hasn't changed. The blueprint is still valid. Or maybe your thesis is that Ethereum or a similar smart contract platform is the foundation for a new decentralized internet, Web3. You believe that finance, gaming, social media, and art will all be rebuilt on these programmable blockchains. If that's your blueprint, you invest in the core infrastructure of that new internet. You look at the projects building the essential tools and applications, and when a bear market hits, you ask yourself one question. Is development still happening? Are people still building according to this blueprint? If the answer is yes, you hold firm because your thesis remains intact. The point is, you need to have one. Write it down. A single sentence. I am investing in cryptocurrency because I believe. And then fill in the blank. This sentence is your anchor. When the news is screaming, when your friends are panic selling, when a tweet from a billionaire sends prices tumbling, you look at your thesis. Has that fundamental belief changed? If not, you do nothing. You stick to the plan. This is what separates investors from gamblers. Gamblers react to noise. Investors act on a signal, and that signal is their thesis. BlackRock has a thesis. Fidelity has a thesis. You need one too. Once you have your North Star, your thesis, you need to determine the second point on your compass, your time horizon. This is your West. It's the when. And for 99% of people watching this, the answer has to be long. I'm talking years, maybe even a decade or more. The get-rich-quick fantasy sold by crypto influencers is just that, a fantasy. It's a marketing gimmick designed to get you to use their affiliate links, so they can make money off your trading fees as you slowly bleed your account to zero. Let's be brutally honest. You cannot outtrade the algorithms. You cannot outmaneuver the high-frequency trading firms. You cannot compete with the armies of PhDs and data scientists working for hedge funds. They are playing a completely different game, a game of microseconds and complex derivatives. Trying to play their game is like showing up to a Formula One race with your family station wagon. You will get lapped and you will crash. So you don't play their game. You play the one game where the average person has an advantage, the long game. The institutions are forced by their clients and quarterly reporting cycles to focus on short-term performance. You are not. You have the luxury of patience. You can buy an asset based on your thesis and simply wait. Consider two investors. We'll call them Day Trader Dave and Decade Investor Diane. Dave is glued to his screen 8 hours a day. He's got charts with a dozen indicators, he's in 5 different paid Discord groups, and his blood pressure spikes with every 1% move in the market. He tries to time the top sell, then time the bottom and buy back in. He's constantly paying trading fees, capital gains taxes on his small wins, and is in a perpetual state of anxiety. More often than not, he sells too early, buys back too late, and slowly chips away at his capital. Then there's Diane. Diane developed her thesis. She decided that a small percentage of her net worth should be in decentralized, digital assets as a long-term bet on the future of finance. She buys a set amount every month regardless of the price. It's called dollar cost averaging. Then she moves her assets into secure, offline storage and goes about her life. She reads, she works, she spends time with her family. She's not checking the price every 5 minutes. She might check her portfolio once a quarter. She is playing the long game. She is using time as her greatest weapon, allowing for compound growth to work its magic, and riding out the gut-wrenching volatility that crushes people like Dave. Who do you think is wealthier and happier in 10 years? Your time horizon is your shield. When you extend your timeline from a few weeks to a few years, the daily noise of the market fades into the background. A 30% crash isn't a catastrophe. It's a blip on a long-term chart. Adopting a long-term horizon is the single greatest way to reduce stress and increase your odds of success. So you have your north, your thesis. You have your west, your long-term time horizon. The third point on the compass is east. This is your risk tolerance, and it's deeply personal. This is the how much. But it's not just about how much money you can afford to lose. It's about how much volatility you can emotionally afford to withstand. I want you to perform a thought experiment right now. Seriously. Imagine you log into your account tomorrow, and your crypto portfolio is down 80%. 80. A $10,000 investment is now worth $2,000. How do you feel? Is your stomach in a knot? Do you feel a wave of panic and regret? Is your first instinct to sell what's left just to stop the bleeding? If you answered yes to any of those, your position size is too big. It's that simple. This is the sleep at night test. Your crypto allocation should be an amount of money that, if it went to zero tomorrow, would be frustrating, it would be disappointing, but it would not fundamentally alter your life's trajectory. You could still pay your rent, buy groceries, and sleep soundly at night. For some, that's 1% of their net worth. For others, it might be 5 or even 10%. There is no right answer, only the answer that is right for you. Ignoring this is the number one mistake new investors make. They go all in, fueled by greed and the fear of missing out. They see stories of overnight millionaires and think it will happen to them. Then, the first major market correction hits, and they are emotionally and financially wiped out. They sell at the absolute bottom, locking in devastating losses, and vow never to touch crypto again. They blame the market, the whales, the regulators, everyone but themselves for their own lack of a sound risk management strategy. Your thesis, your time horizon, and your risk tolerance are inextricably linked. They form a triangle of stability. Your strong belief in your thesis allows you to adopt a long time horizon. Your long time horizon allows you to endure the volatility. And your appropriate position size, your risk tolerance, ensures that the volatility doesn't force you out of the game prematurely. They all work together. This compass, north, west, and east, is your playbook. It's how you navigate this chaotic market with a sense of clarity and purpose. It's how you turn the tables and use the strategies of the patient and the professional, even with a small portfolio. But there's one more point on this compass. The most important one. South. And it's not what you think. It's not about what to buy or when to hold. It's about the invisible force that can make your entire portfolio, your thesis, your patience, everything vanish in an instant, no matter how smart you are. It's the silent killer in this space, and it's the one thing the institutions have mastered protecting themselves against, while millions of retail investors walk straight into the trap. This trap is called the custody conundrum, and it's the single biggest point of failure for the average person in crypto. It's a simple, almost elegant deception. When you buy Bitcoin on Coinbase or Ethereum on Kraken, or any coin on any major exchange, you see the numbers in your account. The dollar value goes up, it goes down. You feel like you own it. You can trade it, you can sell it. But you are living under a dangerous illusion. You do not own that cryptocurrency. What you own is an IOU from the exchange. You have an entry in their private database that says they owe you a certain amount of crypto. It's the digital equivalent of giving your gold bars to a storage facility that gives you a paper receipt. You don't have the gold, you have a promise. And as we've seen time and time again, in the unregulated Wild West of crypto, promises are broken. Think about your bank account. You deposit $1,000. That physical cash is gone. It's commingled with everyone else's money, and the bank then uses it to make loans and investments. What you have is a digital entry in the bank's ledger that says they owe you $1,000, insured by the FDIC up to $250,000. Now remove the insurance. Remove the centuries of banking regulation. That's an exchange. It's a crypto bank with none of the protections. When you leave your assets on their platform, you are willingly handing over control of your wealth to a company that could be mismanaged, hacked, or be an outright fraud, and you would have zero recourse. This isn't a hypothetical fear. This is the story of FTX. Millions of people, from seasoned traders to first-time buyers, poured their life savings into Sam Bankman-Fried's empire. They saw the Super Bowl ads with Larry David, they saw the stadium naming rights, they saw the politicians and celebrities singing its praises. Felt safe. Felt like the future. People had hundreds, thousands, even millions of dollars in their FTX accounts. They'd log in every day, check their balances, and feel a sense of security. They believed they owned those assets. But they didn't. They owned a promise from a company that was secretly gambling with their money. All of it. When the music stopped and the company imploded, it wasn't just numbers on a screen that disappeared. It was people's retirements. It was college funds. It was the down payment for a family home. It was everything. They went to withdraw their money, and all they got was an error message. The vault was empty. The promise was broken. Their crypto was gone forever. This is the catastrophic risk of what's called custodial ownership. You are trusting a custodian, the exchange, with your assets. The institutions, the BlackRocks and Fidelities of the world, understand this risk better than anyone. They would never, ever leave billions of dollars of their clients' assets on a standard exchange account. So what's the alternative? How do you actually own your crypto in the truest sense of the word? The answer is the original promise of Bitcoin itself: self-custody. Self-custody means you and you alone hold the keys to your crypto. It's based on a simple but revolutionary concept: the private key. Imagine your crypto doesn't live in an account on a website. Instead, imagine it lives in a specific, unhackable digital vault on the blockchain itself. There is only one thing in the entire universe that can open that vault and move the assets inside. A unique, incredibly long string of letters and numbers called a private key. Whoever holds that key holds the crypto. Is that absolute? There's a mantra in this space you need to burn into your brain. Not your keys, not your coins. If you don't control the private key, you are trusting someone else not to lose, steal, or gamble away your wealth. So how do you get these keys? Through a digital wallet. There are two main types. First, you have software wallets or hot wallets. These are applications on your computer or phone, like MetaMask or Exodus. They're called hot because they're connected to the internet, which makes them convenient for frequent transactions, but also more vulnerable to online attacks like malware or phishing scams. Think of it like the cash you keep in your physical wallet. It's easy to access and spend, but you wouldn't carry your life savings around in it. The gold standard, the Fort Knox of crypto security, is the hardware wallet or cold wallet. These are small physical devices like a USB drive made by companies like Ledger or Trezor. They generate and store your private keys completely offline, isolated from the internet. To authorize a transaction, you have to physically plug the device into your computer and press a button on the device itself. This means even if your computer is riddled with viruses, a hacker on the other side of the world cannot access your funds. They would need to physically steal your device and know your PIN code to get to your crypto. This is how you truly take ownership. You remove the exchange, the company, the CEO, all of it from the equation. It's just you, your key, and your assets secured on the blockchain. But this power comes with a terrifying level of responsibility. This is the part that scares most people away. And it's why so many walk into the trap of leaving their assets on an exchange. When you control your own keys, there is no customer support. There is no password reset button. If you lose your private key, or more commonly, the 12 or 24-word seed phrase that acts as the master backup for your key, your crypto is gone. Permanently. It is locked in its digital vault on the blockchain forever. And no one, not the wallet manufacturer, not the FBI, not the creator of Bitcoin himself, can ever get it back. You are your own bank. That means you enjoy the absolute control and security of being your own bank, but you also bear the absolute, unforgiving responsibility of being your own bank. This is the game the institutions play. They don't use a simple hardware wallet for their billions. They use what are called qualified custodians, specialized, highly regulated, and heavily insured companies like Coinbase Custody or Fidelity Digital Assets. These firms use complex security protocols like multi-signature wallets, where it might take keys from 3 out of 5 different executives, stored in geographically separate, nuclear-proof bunkers, to approve a single transaction. They have mastered the custody game by building institutional-grade solutions that eliminate the single points of failure that wipe out retail investors. They get the benefits of direct asset ownership without the risk of one person losing a key. They have built the system that allows them to hold this asset class securely, while the average person is left to choose between the risk of an exchange collapsing or the risk of their own human error. So you've learned the lesson. You've seen the smoldering ruins of FTX and Celsius. You've bought a hardware wallet, you've moved your crypto off the exchange, and you've stored your backup seed phrase in a safe place. You are now your own bank. You have achieved true digital sovereignty. You feel safe. You've beaten the custody conundrum. But what if the danger isn't someone trying to steal your key? What if the real threat isn't a hacker but your own government? What if they decide that your personal private sovereign vault is a threat? That the very act of being your own bank should be illegal? Because that is the next war being fought in the United States right now. It's a quiet, complex battle being waged in the halls of Congress and the offices of regulators, and it's aimed directly at the heart of self-custody. They aren't trying to break into your vault. They're trying to outlaw the vault itself. So how do you outlaw a vault? You don't do it with a battering ram. You do it with a pen. With 1,000 pages of dense, mind-numbing regulatory language that slowly, piece by piece, makes the very act of owning that vault a liability. It's death by 1,000 paper cuts. The first cut is usually framed as a matter of public safety, and you have to admit their story sounds compelling. They'll stand at a podium with flags in the background and a very serious look on their face, and they'll talk about ransomware. They'll show you headlines of hospitals being shut down, of gas pipelines being held hostage by shadowy hackers demanding payment in Bitcoin. They'll talk about sanctions evasion, about rogue nations like North Korea using cryptocurrency to fund their nuclear programs. They'll talk about terrorist financing and the darkest corners of the web. And they'll ask a very reasonable-sounding question. Shouldn't we have some visibility into these transactions to stop the bad guys? This is the Trojan horse. It's an argument designed to be impossible to disagree with. Of course, we all want to stop criminals. No one is pro-ransomware. But hidden inside that noble-sounding argument is a fundamental assault on the very nature of digital property rights. Because the tools they propose to stop the bad guys don't just target the bad guys. They target everyone. They create a system of mass financial surveillance that treats every single user of a self-custody wallet as a potential suspect. Let's get specific. Take a rule proposed by the Treasury Department's Financial Crimes Enforcement Network, or FinCEN. It's an extension of a decades-old banking law, Section 6050I of the tax code, which was originally designed to catch people making large cash transactions. Think guys walking into a bank with a briefcase full of $100 bills. The rule says if you're a business and you receive over $10,000 in cash, you have to report it to the IRS, along with the sender's name, address, and social security number. Now, they want to apply this exact same rule to digital assets. Sounds okay on the surface, right? If a business gets $10,000 in crypto, they report it. But here's the poison pill. How does it work with self-custody wallets? If you send $10,000 worth of Ethereum from your personal MetaMask wallet to a company, that company is now legally required to collect your personal, private information and hand it over to the government. This isn't a bank reporting on its customer. This is a merchant being forced to become a surveillance agent for the state, collecting data on a transaction that happened on a decentralized peer-to-peer network. Think about the absurdity. How is the company supposed to verify your identity? What if you're sending from a smart contract? What if it's an anonymous donation to a cause? The technical infrastructure to comply with this doesn't even exist in a way that respects the nature of the blockchain. It's like passing a law that says every time a bird flies over your house, you have to record its species and file a report with the FAA. It's an unworkable mandate designed to make self-custody so burdensome, so legally risky, that people simply give up and go back to using centralized custodians. Back to the banks. Back to the institutions where the government already has its hooks. This is just one front in the war. The other, perhaps more visible front, is being waged by the Securities and Exchange Commission, the SEC, under its chairman Gary Gensler. The SEC's strategy isn't to create clear rules for the road, it's to create chaos. It's a strategy called regulation by enforcement. Instead of publishing a clear framework saying, here's what constitutes a security, here's how to register, here are the rules for exchanges, they just start suing people. They let companies operate for years, raise billions of dollars, hire thousands of American employees, and then one day, they drop a lawsuit on their desk that threatens to destroy their entire business overnight. They did it to Ripple, sparking a multi-year, billion-dollar legal battle over whether the token XRP is a security. They did it to LBRY. They've done it to dozens of smaller projects. And most famously, they sent a Wells notice to Coinbase, one of the largest, most regulated, publicly traded crypto companies in the world, threatening to sue them over their staking services that had been publicly described in their filings when they went public, filings the SEC itself approved. The message is clear. Innovate at your own peril. We won't tell you what the rules are, but we'll know it when you break them. And when you do, we will come for you with the full, unlimited resources of the United States government. This has a chilling effect on the entire industry. It drives innovation overseas. Entrepreneurs and developers, instead of building their companies in Silicon Valley or Miami, are heading to Dubai, to Singapore, to Switzerland, anywhere with more regulatory clarity. The SEC isn't just killing specific companies. It's actively exporting an entire technological revolution, one lawsuit at a time. And what is the SEC's core argument? That almost every single digital asset, with the possible exception of Bitcoin, is an unregistered security. This is based on a 1946 Supreme Court case about a Florida orange grove called the Howey test. They are trying to apply a legal framework from the era of swing music and black and white television to a decentralized, globally distributed, cryptographically secured technology that didn't exist in anyone's wildest dreams. It's like trying to regulate the internet using postal service laws from the 1800s. It just doesn't fit. The goal here isn't investor protection. If it were, they'd focus on actual fraud, on the rug pulls and the scams that plague the space. Instead, they attack legitimate projects and established companies. The real goal, many believe, is to maintain the SEC's jurisdiction and power. By classifying everything as a security, they put the entire crypto ecosystem under their thumb. It also conveniently protects the incumbent financial system. If every crypto asset has to be registered and traded like a stock, then the old guard institutions, the stock exchanges, the broker-dealers, the Wall Street banks, become the mandatory gatekeepers. The very decentralization that makes crypto revolutionary is neutered. So you have this pincer movement. On one side, you have the Treasury and FinCEN trying to dismantle financial privacy and make self-custody unworkable. On the other side, you have the SEC trying to shoehorn all of crypto into a 70-year-old legal framework, stifling innovation and empowering the very incumbents crypto was designed to disrupt. And all of this is wrapped in the language of consumer protection and national security. They're using our desire for safety and security against us, leveraging it to justify a power grab that would fundamentally alter the promise of an open, permissionless financial future. They are trying to build walls around the open prairie of the digital frontier. But these regulators and politicians made a critical miscalculation. They were used to dealing with monolithic corporations they could intimidate in a boardroom. They were used to dealing with a public that was largely disengaged from the arcana of financial regulation. They weren't prepared for what crypto had created. A decentralized global movement of millions of people who not only had their money on the line, but who also had a deep, ideological belief in the technology and its potential to create a more equitable world. They kicked the hornet's nest. And the hornets were starting to get organized. They were about to discover that this community wasn't just going to roll over. It was going to fight back. The fight back didn't start with a bang. It started with a whisper. A million whispers echoing across Discord servers, Telegram groups, and late-night Twitter threads. It was the sound of a vast, decentralized network coming to life, its nerve endings firing in unison for the first time. The hornet's nest wasn't just buzzing anymore. It was starting to swarm. But how do you fight an opponent like the United States government? You can't meet it on a battlefield. Its weapons are not tanks and jets. Its weapons are subpoenas, regulations, and damning press releases. The crypto community realized it had to learn to fight on the enemy's turf, using their weapons, speaking their language. And that meant going to Washington. First came the war chest. Venture capital firms, crypto exchanges, and early investors who had built empires out of code realized that their entire industry was facing an existential threat. So they started writing checks. Tens of millions, then hundreds of millions of dollars poured into funding a new kind of army. An army of lawyers, policy experts, and K Street lobbyists. They descended on Washington, D.C., a city of ancient institutions and old-school power, and they could not have been more out of place. These were tech geeks in hoodies and sneakers, trying to explain the intricacies of decentralized finance and zero-knowledge proofs to senators who still thought a hard drive was a long road trip. Their mission was brutally simple, but monumentally difficult: education. They had to translate the revolutionary, almost utopian ideals of crypto into the dry, cynical language of policy briefs and legislative amendments. They had to convince career politicians that this wasn't just magic internet money for criminals and gamblers. They framed it as the next great American innovation, the next chapter in the story that started with the internet itself. They talked about jobs. They talked about national security. They warned that if America didn't create a home for this technology, it would flee to Europe, to Asia, to Dubai, and the US would be left behind, a relic of an old financial system. They were planting seeds of doubt in the anti-crypto narrative. But seeds take time to grow, and the regulators were moving in for the kill right now. So the industry opened a second front, one where persuasion wasn't the goal. The goal was to win. This was the fight in the courts. This was the brass-knuckle brawl. Companies that had spent years trying in good faith to cooperate with regulators finally decided that the olive branch had been slapped away one too many times. Coinbase, the largest and most regulated exchange in the United States, did something almost unheard of. They sued the SEC. Not because the SEC had charged them with a crime, but because the SEC refused to provide clear rules for them to follow. They were literally suing for regulatory clarity. It was a bold public declaration that the industry would no longer be a passive victim of the SEC's strategy of regulation by enforcement. But the main event, the title fight that had the entire world watching, was a company called Grayscale versus the Securities and Exchange Commission. For years, Grayscale had been trying to convert its massive Bitcoin trust, a product that already held billions of dollars worth of Bitcoin, into a spot Bitcoin ETF. This was the holy grail. An ETF would be the ultimate bridge between the cryptic world of crypto and the familiar world of mainstream finance. It would allow any American with a retirement account or a brokerage app to buy Bitcoin as easily as buying a share of Apple or Ford. And for years, the SEC had said no. Again and again and again. They denied every single application, always citing the same vague concerns about potential market manipulation. But this time, Grayscale didn't just walk away and refile. They took the most powerful financial regulator on earth to federal court. Their legal argument was devastatingly simple and brilliant. They pointed out that the SEC had already approved several Bitcoin futures ETFs. These were complex financial products whose value was derived from the price of Bitcoin. Grayscale's lawyers stood before a panel of federal judges and asked a simple question. How can you say that an ETF based on the future price of Bitcoin is safe for investors, but an ETF based on the actual current price of Bitcoin is somehow too dangerous? The logic was undeniable. It was a legal checkmate. The entire industry, from Wall Street to Silicon Valley, held its breath. This case wasn't just about one fund. It was a referendum on the SEC's entire approach to crypto. It was a test to see if the American system of checks and balances still worked, to see if the courts would rein in a regulator that many believed had gone far beyond its legal authority. Months of legal grinding followed. And then, on a Tuesday in August of 2023, the decision came down. A unanimous ruling. All three judges on the D.C. Circuit Court of Appeals sided with Grayscale. The court's opinion was a stunning surgical takedown of the SEC's position. It called the regulators' denial arbitrary and capricious. It said their reasoning was illogical and inconsistent. A shockwave ripped through the financial world. David hadn't just thrown a rock. He had landed a clean legal hook to Goliath's jaw. The SEC, the agency that brought Wall Street titans to their knees, had been publicly humiliated and legally overruled. While the lawyers were battling in courtrooms, a third, and perhaps the most powerful force was beginning to stir. It wasn't a company or a billionaire advocate. It was the American people. Polls started coming out with staggering numbers. Over 20% of American adults, more than 50 million people, had owned or used cryptocurrency. This wasn't a niche hobby for tech bros anymore. This was a mainstream phenomenon. It was your neighbor, your kid's teacher, your plumber. 50 million people. 50 million voters. And they were paying attention. They saw the value of their assets plummeting not just because of market cycles, but because of hostile government actions. They saw an exciting, promising technology being vilified by politicians who clearly didn't understand it. They started calling their representatives. They started donating to pro-crypto political action committees. They started showing up at town halls asking tough questions. A new, powerful political identity was being forged in the fire of this regulatory war. The single-issue crypto voter. Politicians who can smell a new voting bloc from a mile away began to notice. The ground started to shift beneath their feet. For the first time, you started hearing presidential candidates, from both parties, actively courting the crypto community. They talked about the right to own your own digital assets, the need for clear rules of the road, and the strategic importance of keeping financial innovation right here in the United States. The political calculus had fundamentally changed. Being loudly anti-crypto was no longer a free, easy position to take. Now, it came with a real political cost. The industry was no longer just a punching bag. It had organized. It had fought back in the halls of Congress. It had won a landmark, precedent-setting victory in the courts. And it had awakened a sleeping giant of a political constituency. the establishment narrative that crypto was an inevitable failure, a worthless fraud destined for the ash heap of history, was beginning to crack. The regulators had overplayed their hand. Their aggression had inadvertently unified a scattered, chaotic, and global community into a focused and formidable political and legal force. The victory against the SEC in the Grayscale case wasn't the end of the war. It was the end of the beginning. It had cracked open a door that the establishment had tried to nail shut. And on the other side of that door was the one event that could change everything, the one thing Wall Street and Main Street had been waiting for, the catalyst that could unleash a tidal wave of capital into the market, the imminent and now seemingly inevitable approval of a whole fleet of spot Bitcoin ETFs. The final battle for the soul of crypto in America was about to begin. The stage was set. For 10 long years, the crypto industry had knocked on the door of the Securities and Exchange Commission, asking for a spot Bitcoin ETF. And for 10 years, that door had been slammed shut. Rejection after rejection, a graveyard of failed applications. The reasons were always the same. The market was too immature, too susceptible to fraud and manipulation. Bitcoin, in the eyes of the regulator, was the Wild West, and they refused to give the keys to Main Street investors. The gatekeeper, the final boss in this decade-long quest, was SEC Chair Gary Gensler, a man who knew crypto intimately, having taught it at MIT, but who viewed it with a deep-seated skepticism. He saw a field rife with non-compliance, a minefield for the average person. To him, protecting investors meant keeping them away from the raw, untamed nature of Bitcoin itself. But something had changed. The pressure was no longer just coming from scrappy crypto-native firms. The cavalry had arrived, and they were riding in from Wall Street. BlackRock, the world's largest asset manager with over $9 trillion under its watch, had filed an application. This wasn't just another filing. It was an earthquake. BlackRock had a near-mythical track record with the SEC, with hundreds of ETF applications approved and only one ever denied. They didn't file unless they were confident they could win. Following them came a parade of the biggest names in finance: Fidelity, Invesco, Franklin Templeton. The message was clear. This was no longer a niche asset class begging for attention. This was the financial establishment demanding a seat at the table. Yet, the true catalyst, the move that turned the tide of the war, came not from a financial titan, but from a persistent crypto incumbent, Grayscale. For years, Grayscale had operated the Grayscale Bitcoin Trust, or GBTC. It was a closed-end fund that gave investors exposure to Bitcoin, but it wasn't an ETF. It had a critical flaw. You could put money in, but you couldn't easily take it out. This often caused the price of its shares to trade at a significant discount, or premium, to the actual value of the Bitcoin it held. Grayscale's dream was to convert this trust into a true spot ETF, which would solve this problem overnight. The SEC denied them just like everyone else. But Grayscale did something different. They sued. They took the SEC to federal court. And in August of 2023, the unthinkable happened. They won. The D.C. Circuit Court of Appeals delivered a scathing ruling, calling the SEC's denial arbitrary and capricious. The court pointed out that the SEC had already approved Bitcoin futures ETFs, which are based on the price of Bitcoin, and argued that the regulator had failed to explain why a spot ETF, based on the very same underlying market, was somehow more dangerous. It was a legal checkmate. The SEC was cornered. Denying the new wave of applications from BlackRock and others, after this court ruling, would be almost impossible without inviting a fresh storm of lawsuits they were now likely to lose. The inevitable was finally happening. The final months of 2023 were a whirlwind of frantic behind-the-scenes negotiations. The public saw it as a series of amended S-1 filings, dry legal documents that would flash across news tickers. But what was really happening was a high-stakes chess match between the giants of Wall Street and the SEC. The regulators, led by Gensler, were fighting for every last concession. The biggest sticking point became the creation and redemption model. The big firms wanted an in-kind model, where they could swap baskets of actual Bitcoin for shares of the ETF. It's more efficient and standard for most ETFs. But the SEC pushed back hard. They demanded a cash creates model only. This meant that to create new ETF shares, the firms had to use cash, which would then be used to buy Bitcoin. To redeem shares, they had to sell the Bitcoin for cash first. It was a small technical detail, but it was a massive philosophical one. It was the SEC's way of building a firewall, of keeping the regulated machinery of Wall Street from directly touching the dirty Bitcoin itself. In the end, Wall Street blinked. They all amended their filings to a cash creates model. It was the final piece of the puzzle. The price of admission had been paid. As the January 10th deadline approached, the tension was palpable. The entire financial world was holding its breath. And then on January 9th, chaos erupted. A tweet from the official verified account of the U.S. Securities and Exchange Commission flashed across the globe. The SEC grants approval for #Bitcoin ETFs for listing on all registered national securities exchanges. The price of Bitcoin exploded, ripping upwards by thousands of dollars in minutes. It was the moment everyone had been waiting for. But something was wrong. Just 15 minutes later, Gary Gensler himself tweeted from his personal account. The @SECGov Twitter account was compromised, and an unauthorized tweet was posted. The SEC has not approved the listing and trading of spot Bitcoin exchange-traded products. The market instantly reversed, crashing back down and liquidating hundreds of millions of dollars in leveraged positions. It was a stunning, embarrassing security failure for the very agency tasked with maintaining orderly markets. It was a perfect, almost poetic display of the very volatility and manipulation the SEC had warned about for years, happening on its own front porch. The dress rehearsal had been a disaster. The next day, January 10, 2024, the real approval came. There was no fanfare, no triumphant press conference. It happened quietly after market hours, with the release of a single dense legal document. A decade of fighting, of lobbying, of building, of suing, all culminated in a PDF file uploaded to a government website. The war was over. Gary Gensler released a concurrent statement, and it was anything but celebratory. He made it crystal clear that he was doing this against his better judgment. While we approved the listing and trading of certain spot Bitcoin ETP shares today, he wrote, we did not approve or endorse Bitcoin. Investors should remain cautious about the myriad risks associated with Bitcoin and products whose value is tied to crypto. It was the statement of a man forced to sign a document at legal gunpoint. The court had made him do it. The soul of crypto in America had been contested, and for now, a truce had been reached, brokered not by a change of heart, but by the rule of law. The following morning, the starting gun fired on what was immediately dubbed the Kentucky Derby. 11 different spot Bitcoin ETFs all launched on the same day. A frantic horse race for capital and market share. The giants BlackRock's IBIT and Fidelity's FBTC surged ahead, but a host of others like ARK's ARKB and Bitwise BITB were hot on their heels. The trading volume was simply staggering. On the first day alone, over $4.6 billion worth of shares changed hands. It was one of the most successful ETF launches in history, and yet something strange happened. The price of Bitcoin after a brief pop began to fall. For weeks it bled downwards. The classic sell the news event was in full effect. But the real story was once again Grayscale. As its GBTC fund finally converted to an ETF, years of pent-up selling pressure was unleashed. Investors who had bought GBTC shares at a huge discount were now, for the first time, able to sell at the full Bitcoin price. Billions of dollars flowed out of GBTC, creating a massive headwind for the entire market. But focusing on that short-term price action was missing the forest for the trees. This was never just about a number on a screen. This was about a fundamental rewiring of the financial system. For the first time ever, any American with a brokerage account could buy a piece of the Bitcoin network as easily as they could buy a share of Apple or an S&P 500 index fund. Financial advisors who managed trillions of dollars in retirement savings could now allocate a small percentage of their clients' portfolios to Bitcoin through a regulated, insured, and familiar product. The floodgates hadn't just been opened. The very architecture of the dam had been changed. This was the ultimate legitimacy, a stamp of approval from the very system that had once scorned it. And it set a monumental precedent. If Bitcoin could be packaged into an ETF, what was next? The battle for a spot Ethereum ETF had already begun, and the arguments against it were looking weaker by the day. The approval of the Bitcoin ETF wasn't the end of the story. It was the end of the beginning. The arguments were almost identical. The Chicago Mercantile Exchange had regulated Ether futures, just as it had for Bitcoin. The Grayscale precedent seemed to apply perfectly. To approve a futures-based ETF but deny a spot-based one for the same underlying asset was, legally speaking, arbitrary and capricious. Yet the SEC, and Gary Gensler in particular, had a trump card they were itching to play: the question of whether Ethereum was a security. Unlike Bitcoin, which was universally accepted as a digital commodity like gold, Ethereum's status was shrouded in deliberate ambiguity. The transition to proof of stake, where holders could stake their ETH to help secure the network and earn rewards, looked dangerously similar to a dividend or an interest payment. This one feature could, under the infamous Howey test, classify Ethereum as a security, placing it squarely under the SEC's jurisdiction and killing any chance of a spot ETF, which was designed for commodities. For months, the market braced for denial. Prominent Bloomberg analysts put the odds of approval at a dismal 25%. The consensus was clear. Gensler would use the security question to block the Ether ETF and draw a line in the sand. But then something shifted. It wasn't in the courts or in the fine print of financial law. It was in the halls of Congress. The political winds in America began to change, and they changed with astonishing speed. Crypto, for the first time, was becoming a major election issue. A groundswell of single-issue crypto voters, frustrated by years of regulatory hostility, started to make their voices heard. And Washington listened. In a landmark move, the House of Representatives passed the Financial Innovation and Technology for the 21st Century Act, or FIT21. It was a comprehensive crypto regulation bill, and crucially, it passed with significant bipartisan support, including dozens of Democrats who broke ranks with their party's anti-crypto leadership. The message was unmistakable. Congress was taking control of crypto policy, and the era of regulation by enforcement was on thin ice. Suddenly, the Biden administration was faced with a difficult political calculation. Alienating the rapidly growing and increasingly vocal pro-crypto demographic, just months before a tight presidential election, looked like a terrible strategy. The narrative flipped overnight. In the third week of May 2024, in a move that stunned Wall Street, the SEC suddenly began engaging with the ETF applicants. They requested amended filings on an expedited basis. The odds of approval, which had been languishing at 25%, skyrocketed to 75% in a matter of hours. The market exploded. It was a political pivot masquerading as a regulatory decision. The SEC, likely under pressure from the White House, had been forced to fold its hand. On May 23, the approvals came through. The spot Ethereum ETF was a reality. The victory was even more significant than the Bitcoin ETF. It didn't just legitimize another asset. It legitimized another type of blockchain technology. It tacitly accepted proof of stake as a valid consensus mechanism for a mainstream financial product. The floodgates didn't just open. The dam had broken. If Bitcoin, the digital gold, and Ethereum, the decentralized world computer, could both be packaged into ETFs, what couldn't? Speculation immediately ran rampant. Wall Street started sizing up the next candidates. Would it be Solana with its high-speed transaction capabilities? Or perhaps XRP? Once the SEC's public enemy number one, asset managers like Franklin Templeton were already praising other networks. The question was no longer if other crypto assets would get the ETF treatment, but which one would be next in line. The industry had established a clear playbook: get a regulated futures product on the CME, then file for a spot ETF, and use the grayscale precedent as a legal battering ram. This brings us to the grand finale, the ultimate vision that players like BlackRock's Larry Fink have been talking about all along. This was never just about Bitcoin or Ethereum. It was about the tokenization of everything. The ETFs are just the first step. They are the rails, the foundational infrastructure being built to connect the old world of traditional finance with the new world of digital assets. Tokenization is the concept of creating a digital representation, a token, of any real-world asset on a blockchain. Think of the deed to your house, a share of Apple stock, a government bond, a piece of fine art, or a stake in a private company. Instead of existing as a paper certificate in a filing cabinet or a line item in a siloed bank database, that ownership is represented by a unique token on a global, transparent, and programmable ledger. This isn't a fantasy. It's the destination. Imagine selling a fraction of your home's equity instantly to a global pool of investors to fund a renovation, without months of paperwork and exorbitant fees. Imagine a startup being able to issue tokenized shares to its earliest supporters, creating immediate liquidity and a new model of community ownership. This is the future that the world's largest asset managers are building towards. They see a world where every single financial asset is a token, trading on a global 24/7 market with near-instant settlement. The efficiency gains would be measured not in billions but in trillions of dollars. The crypto ETFs are the proof of concept. They are teaching Wall Street how to handle, custody, and trade these new digital assets within the existing regulatory framework. They are the bridge. And as we stand here today, That bridge is not only built but is being widened at an incredible pace. So, what does all this news from the fall of FTX to the triumph of the ETFs mean for you, for the United States, and for the future of finance? It means three critical things. First, legitimacy is no longer in question. Cryptocurrency has completed its journey from the obscure corners of the internet to the trading floors of the New York Stock Exchange. It is now a permanent and recognized part of the global financial system. The debate is over. Second, the future of crypto in America will be one of regulatory clarity, not chaos. The passage of bills like FIT21 marks the beginning of a mature, sensible approach to regulation that will provide clear rules of the road for builders and investors alike. This certainty will unleash a wave of innovation and investment that has been sitting on the sidelines for years, solidifying America's role as a leader in this new technological frontier. And third, crypto is now an American political issue. It has a seat at the table in Washington, D.C. This ensures that the industry will have a voice in shaping its own future, moving beyond the whims of a single regulator and becoming part of the national conversation. It's a powerful new check and balance that protects the entire ecosystem. The story of cryptocurrency in the USA today is a story of resilience. It's a story of a transformative technology that survived a brutal bear market, a cascade of corporate failures, and an unprecedented regulatory assault, only to emerge stronger, more legitimate, and more deeply integrated into the fabric of our financial lives than ever before. The institutions have arrived, the legal precedents have been set, and the political landscape has been permanently altered. The end of the beginning has given way to a new chapter, one that will be defined not by the fight for survival, but by the race to build the future. The foundation has been laid. Now the real construction begins.